You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
Hey folks, welcome back to the Shoe In Show. About a month or two ago, I told you there would be an economic slowdown in September as people came back from vacation and were hit by credit cards and the realization their kids were going back to school and there'd be some kind of cognitive reset and people would pull back on spending. Well, I'm here to report that I was wrong. I don't say that very often. I don't like saying that. But I was wrong in a
Your wife says all the time.
Yeah, well, I get told that. I don't admit that. See how that works? But Q3 GDP just got reported out. And if it, it's almost 5%. It's actually unbelievable. I mean, obviously we'll wait for a revision to see whether
down to 2%.
I don't know, but like having a first look at 5% GDP driven by consumer spending. So my concern is, where are you getting the money from? Like, obviously, like there's full employment, wages have gone up, but inflation is still there. So maybe there's some inflation in there that's built in. Maybe the prices are a little bit higher, so there's more spending because the prices are higher. But I mean, this is kind of, again, unbelievable 5% GDP.
You're getting the money from the future, Andy. It's like Bill and Ted. You're like going and grabbing the money from the future and paying for stuff now.
Well, if I were Biff and I could get the betting magazine to go back in time and start placing bets.
There you go, Sports Almanac.
Yeah, that's right. So obviously, I would do that. I've been working on the time machine for quite some time. It's not that good. I will say this: I saw a Tesla the other day that has like the DeLorean doors that open up.
Yeah, those are cool. Yeah.
Kind of weird. Not really sure why I need doors to open up like that unless they're going to fly.
I rode in one of those in Portland before the pandemic in an Uber, and it was like it was like a transformer, and you get in it and it takes you away.
Interesting. Well, yeah. Anyway, we're trying to unpack what this is, and we're also trying to unpack, like, we know that we brought in way too much product last year, right? It was an overcorrection. But the anticipation was that it may take longer to get through some of the inventory. I mean, it's hard to say. Most brands won't share specific inventory data. But it seems like it's a weird time because you're looking at this information, and we obviously have on our economists to talk about this. You look at this growth, and you look at spending power, and it doesn't seem to be tapering that much. Like, obviously, credit card debt's there, but they're still spending a lot. So do you bring in more inventory, or do you keep correcting the inventory level?
No. So the reason we wanted to have Gary on is that Gary and I, more Gary than I, have been working on a way to capture inventory and some kind of reporting. And we've, over the years, have engaged with members, and rightfully so. Members are they're a little skittish as it relates to sharing inventory numbers. And so Gary pulled together, just looking at 15 or so public footwear companies' inventory levels as reported publicly, how we could create not an index, as I've learned, but a collection of combined inventories. And when Gary sent over the chart to me, and then we ended up putting in what I'm hearing recently, I was blown away. While inventory levels are coming down, they are still so elevated historically. That I was like, Gary, you got to come on Shoe In Show and talk about this. And I think it plays nicely, Andy, into your point on the GDP number and consumer spending. And so, Gary, welcome to Shoe In Show. Talk us through the inventory as you see it right now. Kind of what are the takeaways as it relates to inventory levels?
Yeah, just echoing what Andy said, it's been this wild gyrations in both on the consumer side and on the inventory side post COVID. That of course, early days of COVID, everyone stuck at home, glued to the TV, not venturing outside. Of course, consumer spending just absolutely collapsed, Meanwhile, there was still a lot of product coming in. Of course, you saw this, back and forth over the next, couple of years since then, with inventories plunging and then inventories, surging after that. And we're still looking for that new normal, this new equilibrium in the wake of this. And, to Matt's point, we're seeing the inventory numbers come down modestly, but my goodness, they're coming down from levels that we have never seen before. Going back, 10 years ago, between this 15 or 18 or so different companies Matt was talking about, the combined aggregate footwear inventory number was some 13 to 15 billion dollars, quarter after quarter, and it would increase modestly over time. But then in the early days of COVID, that number absolutely surged. Here just a couple quarters ago had reached upwards of $25 billion. As I said, we've seen it come down a bit since then, but there's still a long way to go to return anywhere close to the good old days of even just 5 years ago, let alone 10 years ago. So yeah, I think there's still an awful lot of inventory in the pipeline. And that comes, as Andy said, if we're seeing this presumed slowdown from such robust third quarter economic growth driven by the consumer. If we see this slowdown spill over into 2024, then I think it's going to take much longer, protracted time to see those inventories get pared back down closer to this, long-term normal level.
Hey, just to visually, so because this is an audio experience and not a visual one. When you look at the chart, it looks like we hit the peak of a mountain, but now we're just walking along the ridge line, right? So you're dipped down a little bit, but it is. We peaked at, I'm just looking at $25 billion, and we're hovering around $24 billion in still inventory holdings by value. Now, Gary, to the inflation question, is the value of that going up while the pairs are coming down? Is there something that's behind that as a layperson you could say, all right, so I get it, but inventory from a pair's perspective is coming down, just the value of it's elevated because of inflation?
Yeah, great question. Of course, these inventory numbers come from publicly reported data on a company's quarterly and annual, financial filings, income statements, and we've seen that these numbers, of course, are reported in dollar terms, not in volume terms. So really, we can't tell. There are ways to get at that from other sources, particularly looking at import volumes and import values coming in. On that side, yes, we've seen that the average unit cost has been declining at a pretty good clip here the last couple of months. That is a pronounced reversal from where we were, a year or 2 years ago, with this average unit cost, increasing much faster. So yeah, we're seeing both the volume and the value of these shipments come down, and presumed, as you said, we're kind of walking along that ridge line near this high. The assumption is we're seeing both the volume and value, these inventory numbers of what's already here, already in the U.S., come down as well. But I think we're seeing the value basis come down a little more than the volume basis is.
I think it's important to go back to a conversation we had many months ago, but we had on a stock analyst, Sam, came on and was talking in particular about, and we had this conversation where I asked him, is it okay if you run out of product? And he said, yes. That means you stocked out, right? Good job. You sold out. You don't want to be sitting on anything. And it gets back to this question as to the art of inventory management. And if you're sitting on this peak, and we know that consumers keep spending, but I guess the challenge is knowing or forecasting. It's almost like buying a stock and trying to know when to buy low and sell high, right? You never quite get it right, and you should never quite play it that way, because you can get bit pretty hard. But I think that's where we're at as an industry, is trying to figure out that right pricing strategy over the holiday season, not giving away too much with tighter margins, but also looking ahead, because, I'm looking at the data here. So and maybe we can look at this from a larger level, Gary, but I'm looking at durable goods were almost 5% in September. So that's a huge indicator, because that's larger ticket durable good items that consumers are leaning into purchase. If there was a tapering of spending, you would see that drop. And there has been drops previously, but you got 5% there. Unemployment is okay. It's kind of steady. That the concern that I have, and I'm looking at the data here, it says that personal savings rates declined to 3.8% compared to 5.2% in the previous period. What does that mean when you see that, Gary?
I think it goes to your point you said earlier, talking about Biff from Back to the Future. Borrowing from the future.
Yeah.
McFly.
Exactly. We're seeing so much of that now that we're seeing this record credit card debt that consumers are holding. And I'd reported on some numbers the other day that it's estimated that a record share of holiday shoppers is expected to purchase on the buy now, pay later. So they're continuing to borrow from the future in several different ways to consume now, but to pay for later. And I think that's unsustainable long term. That I think it's the combination of those record credit card debts, the increased share of buy now, pay later, of course, the record interest rate on this credit card debts, not to mention, the resumption of, student loan payments, all these, I think, pretty stiff economic headwinds, I think, are likely to weigh on the consumer as we, turn the page into calendar 2024.
Hey, Gary, as a Fed watcher, you show this on our weekly calls, you dissect each of the Fed's various speeches that are happening at a given time and really kind of point out things that are said and some of the messaging. When you get the GDP number Andy referenced at the start of this conversation, what do you think the Fed's thinking right now?
I think the Fed is thinking that they're going to stay put. In fact, I was looking at numbers in the wake of the GDP announcement. There is a metric that measures the likelihood of the Fed to change interest rates at each subsequent Fed meeting. Right now, there's about a 98.6% chance that the Fed is not going to do anything at this next meeting. So I think we're not likely to see much of any movement in the Fed increasing or decreasing rates anytime soon. If we see the economy kind of continue as it's trending now, I do think we're likely to see weakness, as I said, fourth quarter and headed into 2024. But I think the Fed is more likely to just kind of coast for the time being. I don't think they're likely to tweak policy higher or lower, looser or tighter, one way or the other, really for any time in the next several months.
I think a lot of that too is due to the fact of the war in Israel, and the realization that geopolitics flare up really fast. And when those things, we don't know how this is going to impact oil prices over the next 2 weeks. We don't know. And so when that happens, you have to be very agile. You don't want to do any harm that would, further magnify a decision. So sometimes you have to sit on it because you don't know. And even now, Gary's looked at this for a long time, and I track some of the data coming in and out as kind of an amateur, but a lot of this data doesn't make sense. We have never lived in an era like this. So if you want to compare things, you could look at the 80s and 70s here and there, but you're looking at an age today of technological shifts and changes that are they're much faster and accelerated than in the past. So if you're a Fed looking at that, you can look at historical information and try to make a decision, but your decision impact is a lot faster. Obviously rates go up and it takes, months and months for that rate increase to filter across. But there's other things that are happening that happen in real time. Look at the great example is these stock memes that happen in real time, right? Used to, you'd have a stock and it would, earnings would come out, and over 2 weeks you would have, in the 80s, you would have people start buying into IBM or something like that. Well, today, people buy every single minute and the stock goes way up or it goes way down, and the shifts happen super fast. So when we're looking at this stuff, I think the Fed in particular, Gary, is looking at it saying we can get our bearing, but we don't know what wind's going to shift the boat coming ahead really quickly.
Yeah, to your point, we're in the Robin Hood generation now, to where so much of these meme stocks that can really spin on the dime. But yeah, we're looking at monetary policy. It's like you're turning the battleship. That takes 12, 18, 24 months to begin to see that percolate across the broader economy. And there's we're not seeing that issue happen any faster than it happened 30, 40 years ago, unlike issues like advances in technology that make so much more communication, so much more social media commonplace these days, and meme stocks so much more to be able to spin on the dime, like we said, versus monetary policy.
Let me ask you this, just for the broader education of our listeners. I mean, we've had a lot of focus on Birkenstock's IPO and its addition to the economy or to the stock exchange, and then just overall, obviously, we pull this inventory number from publicly traded footwear companies, but bond yields are increasing. Talk about the historic nature of how bond yields go up, and that threatens the long-term yield on equities. Like, what's the interplay there, and how are footwear people to understand that dynamic?
Sure, there's a bit of an inverse, relation, a negative, correlation between the two. That typically, as bond yields go up, you tend to see equity values go down. And of course, with bond yields now at the highest levels we've seen in years, it's really weighing on equity prices. Again, it doesn't apply to every company all the time, but in the aggregate, on the whole, there's a pretty strong inverse relationship between the two, and it's something that I think we're only likely to see bond yields remain high, perhaps climb even higher than 5%. We saw the 10-year bond yield cross 5% just here recently, and I think it's likely to continue to strengthen even further. And I think that's something that's likely to weigh on equities again as we turn to 2024.
Is that because demand moves into the bond market? Is that how? I mean, is that a simplistic way to look at it? That investments are demand is coming down on the equity side and moving into the bond market because it's a safe investment and it has returns that we haven't seen in decades.
That's I think it's part of the equation. As an investor, as Joe investor sitting back looking at this going, well, should I put my money in an equity that may or may not increase in value, or over here where I'm guaranteed 5% for the next 10 years and I don't have to do a thing? Well, it really, I think it tilts the decision to more something like the safer bet.
Yeah. Thanks, Joe investor. I appreciate that guidance.
Yeah.
Gary, let me ask you this. If I'm a CEO or a C-suite and I'm looking at 2024 and I'm trying to make my planning around sales and comps and things like that, what are three things that I need to be like laser focused on around that? And I'll tee you up for this because in my estimation, one is the savings rate that we just talked about. It's gone down. Another one is consumer credit card debt, which has gone up. The other one, which I think is interesting, and you can go with it or not, or however you want to look at those three things, 401k rates, really interesting to me at this point. You got boomers retiring. The Wall Street Journal, weeks ago ran a really interesting thing about how the economy in some ways is being floated by retirees who have, seen their 401ks go up substantially, obviously a little rocky right now, but had this extra income to spend and have kind of been floating because there's so many of them now. We have a mass number. I never thought about it in that way of looking at like 401k issues where you have this kind of spending area or spending growth. What's your take? What's three things in particular that people should zero in on right now as they do their strategy for 24?
Oh boy, only three.
Yeah, just three.
Yeah. I think you really nailed a couple good ones. That the saving rate at maybe 3.8% is well below its long-term average, near its lowest in the last 50 years or so. That is an issue that goes to suggest that consumers just don't have a whole lot of cushion versus a couple years ago, pre-pandemic. Looking at issues like 401k and the retiring baby boomers, that has been an issue that for decades has been a strong headwind, pushing the economy and pushing equities. That you've had this huge cohort of the population that has been aggressive in these passive investments like 401ks, essentially set it and forget it, and they're continued to buy and buy and buy in these stocks, as their 401k balances. As 401k contributions increase over time. Now that pendulum is beginning to shift, and you're seeing more of those boomers begin to retire, I think it suggests you're not going to see that pendulum shifting in the buy side. You're going to see more to a neutral to the sell side. And I think that's something that's likely to weigh on equities, and I think will affect pocketbooks for millions of us for really decades to come, as you see that large cohort of boomers move into the retirement phase of life.
All right. Well, lots to think about. As always, it's fluid, and that's exactly why we have a weekly call every Tuesday at 2 p.m. Eastern. Our team is on a call. Gary brings up the latest economic data. We do micro data on footwear in particular. We do macro, Mickey Mouse data as well for the Floridians. But we do a range of data sets that focus on footwear and the broader economy to help companies better understand what's happening in real time. And we're also at beck and call of members. So as they're going through strategy sessions, please reach out to us. We're happy to pull data on imports. So you can look at your specific inventory levels against industry averages, look at cost issues. We look at material costs. We look at prices at retail. We look at e-com sales, brick and mortar in total. We look at the entire shoe economy, and Gary tracks that for us and reports it. So if you have specific data sets you're looking for as you make your strategy for 24 and beyond, please contact us. We're happy to get on a call and cover that with you. That's free as part of membership, by the way.
Nice.
We are a nonprofit that focuses on helping footwear companies make better decisions in a tough market. So if you're not a member, here's a little plug for that. But please get on the weekly call. That is the number one thing that you can keep up to date with this information in real time. But Gary, thanks very much for coming on and shedding some light on some of this stuff. And the inventory information that we have, we put that out in Matt's What I'm Hearing, which comes out on Mondays to CEOs and executives. Is that going to be a monthly report we put out? What are we looking at there? Quarterly or?
Yeah, I'm thinking the cadence is likely to be quarterly as we get quarterly data on new companies. But of course, there's new data coming out all the time. But I would imagine quarterly going forward.
Yeah, well, it makes sense, right? Because when we look at the import numbers, there is a ebb and flow to imports and exports, and so we need to look at it on a longer timeline for the inventory as it comes in and goes out. So that makes good sense. Folks, as always, shoeandshow.com is our website. You can go and listen to all the different episodes. Again, contact us if you are looking for specific data. We're here to help in these weird, strange, ever-changing times. We're here to help you and your business. So put us to work. We appreciate everyone for listening. Make sure you tell friends and colleagues, pass this around, subscribe. Next week, brand new episode drops. Hot. 5 stars only. We love you, and Shoe In is out.
Shoe In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.